one of the things you say is kind of a warning that China should take Trump seriously. About what?
I think about bilateral trade. I mean, we can talk about complicated supply chain, so on and so forth, value added. But in the end, I think Trump administration is taking so-called surplus countries very seriously. So China is on the top of the list, followed by Germany and Japan. And more importantly, I think some people have attributed this a very large bilateral trade surplus favoring China to certain states' very protracted job losses among blue-collar workers. So I think China should take Trump seriously.
Do you think on that indicator alone, they will label China a currency manipulation?
I don't think that's the case. I think everyone knows China is trying extremely hard to keep RMB exchange rate stable. Otherwise, I mean, today's exchange rate probably would have been above 7 against US dollars. So right now it's not even 6.9. So I mean, China is trying very, very hard. I don't think currency manipulation is an issue, but I think market access is an issue.
Yeah, I mean, I want to bring up this chart, 64.98. I mean, it is that exactly illustrates what you suggest, this correlation between foreign reserves and the yuan. As you say, this tells the same story. I mean, we're in an era where it's really domestic factors that are driving yuan policy, not this need to devalue for competitiveness, for global trade competitiveness.
No, it's not about competitiveness. I think if you look at, for example, the data from WTO, data from IMF, actually compelling evidence suggesting China's market share, product market share in developed countries, Australia, New Zealand, for example, included, actually staying remarkably stable. So that actually suggests Chinese products stay competitive. But at the same time, I believe RMB-denominated assets are extremely expensive. So you look at real estate in Sydney, Melbourne, but comparing to Beijing, Shanghai, I mean, it's no comparison. I mean, so there is this strong need, urge for domestic firms and consumers to diversify. That's natural. I think that force in the medium term will dominate the trade surplus.
I was just talking earlier with Tom Orlick, our Bloomberg intelligence economist, about this codependent relationship, right? If you take a look at this bar chart on the Bloomberg, we're off these historic highs when it comes to the amount of trade that the US does with China as a proportion of total trade, global trade, but still very, very high, that 2016 number at 17%. If you were to weigh it up, I mean, who needs the other more? You know, Tom makes this point, which I think is very much lost among some of perhaps Trump's supporters that want him to get tough on China, is that, you know, that is actually the part of the American consumer that's going to be missing out on these cheaper Chinese goods, and that is going to have its own negative impact on the US economy.
I mean, it's difficult to say who needs more. I mean, without China today, I mean, you look at short-term interest rate globally, would be at a very different level. Without China, I don't think real estate prices in Sydney, Melbourne can sustain today's valuation because interest rate would have been higher without China. So it's difficult to say, but I do think at this point, there is a very important word being highlighted by some policy wonks in Washington, D.C., reciprocal, meaning, you know, China should open up certain sectors. Actually, that's exactly what China wants to do in the long run. But in the short term, I don't know whether there's a sense of urgency. So, for example, financial services, healthcare, education, entertainment, and so on and so forth. So I actually think China has leverage, and the leverage is meaningful market access.